Fair value gaps remain one of the key concepts within trading. But when the market is bullish and several fair value gaps appear on the chart, which fair value gap is likely to react? And most importantly, is it sensible to enter at each fair value gap? Absolutely not. In today's session, we'll understand how to spot a high probability fair value gap. And why do fair value gaps develop? What is the psychology operating behind them? What are the various types of fair value gaps? And most importantly, where to position entries and where to take exits. So, if you wish to elevate your trading to the next level, make sure to watch this video till the end so every concept becomes crystal clear for you. But before advancing, if you find this content valuable, hit that like button, and if you're new here, remember to subscribe and enable notifications so you never miss our latest uploads. I'll catch you right after the intro and disclaimer. So, first, let's break down what a fair value gap is. A fair value gap is a price imbalance formed when the market moves extremely fast. When price moves rapidly, certain zones are left behind where proper buying or selling cannot take place. We refer to that zone as a fair value gap. This gap behaves like a magnet. Price frequently comes back to that zone to remove the imbalance. This imbalance is typically recognized by 3 candles. When the first and third candles' wicks do not overlap each other, the empty space between them is called a fair value gap. A bullish fair value gap. When there is a gap between the upper wick of the first candle and the lower wick of the third candle, and that gap stays inside the body of the middle candle, it is called a bullish fair value gap or a bearish fair value gap. If the lower wick of the first candle doesn't connect with the upper wick of the third candle, and a gap appears inside the middle candle, it is called a bearish fair value gap. In both scenarios, the gap that forms within the body of the middle candle is labeled a fair value gap, also known as FVG. This gap signals either a reversal or continuation in the market. In a bullish condition, price may push upward, and in a bearish condition, price may drop. However, if the wick of the first candle touches the wick of the third candle, that fair value gap becomes invalid because the gap has been filled already. This implies that price action has already taken place. There are 3 primary forms of price imbalances. The first, most frequent imbalance is the fair value gap you just learned. This gap usually forms inside a 3-candle pattern and is easily noticeable on the chart. It is a strong zone of interest because the market aims to fill this imbalance. The second type is a volume imbalance. This forms when there is a gap between the closing price of one candle and the opening price of the next. Trading is active, yet there is a disparity in volume, meaning the distribution of volume is uneven. When the market identifies a volume imbalance, it drives price toward that zone to restore balance. This imbalance impacts price behavior, and price responds accordingly. The third type is an opening gap. This is the most simple and direct imbalance. When no candle exists between the prior day's close and the new day's open, a clear gap appears. This means no market activity occurred in that price zone. The market must fill this gap quickly because adjusting overnight movement is necessary. So, this gap fills rapidly, creating a short-term trading setup. It's essential to understand the contrast between a volume imbalance and an opening gap. During a volume imbalance, trading continues and candle wicks overlap. However, in an opening gap, no trading happens at all. There is simply complete price avoidance, where the market makes 0 transactions in that price range. Now let's grasp the psychology behind the creation of a fair value gap. Why do we refer to this gap as imbalance and inefficiency? It's straightforward. For every buyer in the market, there must be a seller. If I'm selling something, someone must be buying it. But when price suddenly accelerates aggressively in one direction, displacement takes place. At that moment, the seller does not receive a fair price, leaving a void that we identify as a fair value gap. The market is naturally efficient and always seeks to correct imbalance. So price instinctively moves back toward that gap. The gap gets filled, and from there, either a continuation or reversal occurs. By now, you should understand what a fair value gap means. But the real difficulty is this. When the market is bullish and several fair value gaps appear on the chart, how do we figure out which fair value gap is the strongest? And should we enter at every fair value gap? Absolutely not. To determine a high probability fair value gap, we must review 4 powerful criteria that help us recognize a strong and dependable fair value gap. First, market structure shift. FVGs created during a market structure shift or break of structure perform best when the market breaks a major level, such as a significant high or low, followed by a fair value gap. A strong move is developing. These fair value gaps typically behave as support or resistance. Price often pulls back, fills the gap, and then continues in its initial direction. This area consistently offers quality trade opportunities because it reflects strong market intent. Therefore, when a market structure shift appears and a fair value gap forms, it can create a high probability setup. Second, unmitigated. A fair value gap is high quality only when it remains unmitigated, meaning price has not touched or filled it. Once price fills the gap, it is no longer valid for future reactions. When price first taps the FVG, we can anticipate its behavior. If price respects the fair value gap and rejects from it, that zone may act as support. But if price breaks through the fair value gap and closes below it, it becomes resistance. The sell side will then target liquidity. Third, discount and premium zones. Where the fair value gap appears is critical. Not all fair value gaps carry equal weight. If the market is bullish, prioritize fair value gaps formed inside the discount zone. These are strong buying levels. And in a bearish market, prioritize fair value gaps located inside the premium zone. These are ideal areas for short setups. Fair value gaps created at extreme market points have a higher probability, where your risk to reward becomes optimal. Fourth, support and resistance barriers. If a fair value gap forms near a major support or resistance level, the probability of a reversal increases. So if price turns against you, your stop loss might get hit. Avoiding such fair value gaps is a wise approach. Always choose fair value gaps away from heavy zones, where price has room to move cleanly without major barriers. Now you've learned how to identify high-quality fair value gaps. Let's talk about a simple yet powerful strategy that uses 2 time frames. A higher time frame and a lower time frame. On the higher time frame, the main factors to watch are market direction, key levels, liquidity zones, and most importantly, fair value gaps. Second, lower time frames. On lower time frames, we focus on reversal areas, fair value gaps, and planning the entry. Remember, the entry time frame should always be at least 2x smaller than the analysis time frame. For example, if you're studying a 4-hour chart, then use a 15-minute chart for your entry. You may also blend time frames as needed. First, analyze market structure on the higher time frame. Generally, while analyzing, we apply smart money concepts such as breaks of structure, change of character, and liquidity traps to determine market direction and key zones. Here, we can see multiple bullish break of structures on the chart. This clearly confirms a bullish trend. The next task is to mark high probability fair value gaps on the chart. Then we use the fair value retracement tool to see whether price is in a discount or premium zone. In a bullish environment, focus only on fair value gaps lying in the discount zone. Once we've found our ideal trade zone on the higher time frame, we wait patiently for price to approach that zone. As soon as price taps into the zone, we switch down to a lower time frame to look for reversal signals and execute the position. Lower time frame. A key reminder here, when price reaches our higher time frame fair value gap, we don't enter blindly. We must wait for signs that the short-term down move has ended, and the market is prepared to push upward again. The first clue for confirmation is a change of character. When price breaks the previous short-term high, it signals buyer strength. This is called a change of character. After spotting the change of character, we locate a fair value gap that offers the most precise entry. The entry plan is straightforward. Place a buy limit at the start of the fair value gap. Our stop loss will remain below the fair value gap. Move to break even once the first target, a 1-to-2 risk to reward ratio, is achieved. Our final target will be the swing high on the next higher time frame. Now, here's a 15-minute chart. This is our higher time frame, where the market is forming bullish structure, creating higher highs and higher lows. So the trend is bullish. We wait for price to dip into the discount zone and mark the fair value gap there. Then we drop to a lower time frame and wait for confirmation, such as a change of character. Once confirmed, we hunt for a fair value gap. Our entry and stop loss stay inside that fair value gap. with the stop loss at its low and the target at the swing high. This is a 1-hour gold chart. Here, the market has broken a previous swing low and clearly shifted character. This means the direction has flipped from bullish to bearish. We will now look for a fair value gap within the premium zone. Then, we switch to a lower time frame. To verify the change of character, we identify the fair value gap and enter there. The stop loss will be at the low of that fair value gap and the target will be the swing high. That's it, traders. Thank you for watching this video. If this video brought you value, make sure to tap the like button. Don't forget to subscribe to the channel for more simple and effective trading content, and hit the bell icon so you never miss future updates. See you in the next video.